Satish Ramanathan, Director and Head of Equities with Sundaram Mutual Fund, joins us now. Satish, morning. Always a delight to have you back on ET Now. Thank you for joining us. Satish, what would you say is the biggest irritant for Indian markets? Would you agree more than crude or global cues it is rupee?
I think in terms of rupee is going to be a continuous issue for the country, primarily because of our trade deficit and our large oil imports. So until we balance this either through FDI inflows and FII inflows, or we cut back on consumption, it's going to remain a challenge, ongoing challenge. Having said that, I think Indian currency has been amongst the weakest across the region, and therefore we don't see it going way below the current levels. There may be a 5% or 6% further depreciation, but going far below this doesn't look warranted.
Right. Earnings so far have been in line to negative for key companies. How are the markets really reading into earnings and the outlook on that front?
I think the quarter four earnings, they have been, it's been a mixed bag in terms of surprises and in terms of which have been mainly negative surprises. I think from a market perspective, a fact that we are probably heading towards a 0% earnings growth after a long time comes as a bit of a shock. And we also need to bear in mind that many of the commodity companies which constitute a large percentage of the index will have a fairly volatile earnings going ahead. So consequently, I think from a market perspective, a lot of this will continue to be a surprise as we move along.
Satish, are you a bit surprised, first, A, that rate-sensitive stock sectors have been marked underperformers despite a Reserve Bank of India rate cut? And B, what is your strategy now going forward when it comes to rate-sensitives?
I think, see, the key thing about interest rate sensitive sectors is not about the interest rate itself, it's rather than the outlook on these sectors. In the case of banks, it is not the interest rate which is worry, rather than the asset quality which is a primary concern. So as long as we are comfortable with the asset quality, the rate up or down by 50 basis points really doesn't change the big picture. And the same holds true for infrastructure companies. It's not about the borrowings, but rather about the ability for the company to service its debt based on the existing projects that it has taken and the cash flows of the business. So we are very clear that this rate cut of 50 basis points and tinkering that the central bank does really is not going to restart economic activity in a big way or break the economic activity in a big way. I think we are entering a natural process in the economic cycle where companies have borrowed way too much and must find ways to pare down the debt. And on the banking side, they have loaned too much and too fast to companies which have long-term projects, and consequently they will have to therefore stop giving long-term infrastructure projects for the time being till some of these projects start paying down their debt.
Right. What about the defenses? And this is much talked about, the fact that consumer and FMCG stocks are trading expensive. How would you approach them?
In terms of the defensive sectors, our view is that they will continue to be much more resilient than the other sectors that we have, especially banking and infrastructure names. And we expect them to be more resilient simply because India is an under-penetrated economy as regards many of these consumer items. Consequently, the growth rates for these companies may come down, but will not touch minus 15 or minus 10%, but maybe probably plus 5 from plus 12 or plus 15. Therefore, the volatility in earnings in many of these companies will be far lower. And don't forget that all these companies are extremely high ROE companies with free cash flows. Therefore, the volatility in cash flows will be far less, and they are debt-free, and hence they will be much less volatile compared to the other rate-sensitive sectors.
Satish, so in terms of an EPS number for FY13 for Sensex, what are the numbers you are now working with?
We really don't make these kind of forecasts because we look at it from a very company-specific and a valuation-specific basis. But having said that, in terms of the street estimates, they are always there of around 1250 to 1270 going ahead, and so whether they actually come through or not remains to be seen.
Right. The other aspect, Mr. Ramanathan, is really, how reforms pan out. Are you worried on the reforms front in India, because that's hitting sentiment overall?
See, I think the reform process has to be one of a continuous one, whereby we open sectors and allow FDI to come in on a continuous basis. It cannot be open-shut kind of a situation whereby we see FDI allowed for retail, then FDI allowed for insurance, and then it stops. In terms of free capital movement, we will have to naturally open up more and more sectors for global investors to invest in, and then also allow Indian companies to invest globally as well. So it is a two-way process, and the fact that we need foreign exchange will only pressure the system to open up quicker than before.
Satish, Europe, a problem which vanished about a quarter ago suddenly has surfaced up again. How do you view Europe now, and what do you think will be the impact of the current political uncertainty in Europe on our markets?
I think at a primary level, all markets are interlinked, and the European issue seems to be building momentum once again, especially in the case of Greece, which has voted more against austerity, and consequently it means that they may have to step out of the EU itself. So a lot of bargaining and counter-bargaining is taking place, and we really cannot take a call as to what the outcome will be, but there will be volatility going ahead based on this issue, and to some extent the market is also used to this volatility, and therefore the level of movement may not be as much as what we have seen in the past.